Welcome to The Explainer. So, you've thought about investing in stocks, but maybe felt like you were standing at the bottom of a huge mountain with no idea how to start climbing? Well, this is for you. Today, we're going to turn all that uncertainty into a clear, step-by-step system you can actually use.
If you've ever felt totally overwhelmed by the stock market, like you're just guessing or maybe acting on a hot tip from a friend, you are definitely not alone. The truth is, for so many beginners, investing feels like a game of chance, something driven more by gut feelings and emotion than by any kind of solid plan.
But what if you had a system, a reliable framework that acts like a GPS for your money, guiding every single one of your decisions? Well, that is exactly what we're going to build today. We're diving deep into what we're calling the 4 pillars of investing, a method that's all about replacing guesswork with a structured, logical process.
Okay, so here's our game plan. First, we're going to reframe how we even think about investing. Then we'll get into the details of each of the 4 pillars: what to buy, when to buy, how you get paid, and crucially, how to stay safe. And then at the end, we'll see how it all clicks together to create one cohesive system. All right, let's get into it.
Our journey starts with the most fundamental question of all. What actually makes a company worth your money? And I'm not talking about picking a popular name you've heard of. This is about identifying a truly strong business. That's the core of Pillar 1.
The legendary investor Warren Buffett really boils his whole idea down to one simple phrase: price is what you pay, value is what you get. See, it's not about finding the cheapest stocks, it's about finding great companies at a fair price. Think about it. The price is just that temporary number you see flickering up and down on your screen. But the value, that's the real, lasting strength of the business itself. Its profits, its brand, its place in the world. That's the big mindset shift right there.
And the technical name for this whole process is fundamental analysis. The best way to think about it is that you're becoming a business detective. So instead of getting mesmerized by a zigzagging stock chart, you're looking at the company's health records, its income statement, its balance sheet. You're asking the real questions. Is this business actually making money? Is it drowning in debt? For instance, a detective might look at something called the price to earnings, or PER ratio. It's just a simple metric that tells you how much investors are willing to pay for every dollar the company earns. A super high PE might be a red flag that a stock is expensive, while a low one could signal a potential bargain.
Buffett actually systematizes this detective work into 4 rules that are non-negotiable for him. First, is the company run by honest, capable people? Second, does it have a real long-term advantage, something that protects it from competitors for years? Think of a powerful brand like Coca-Cola. Third, is the business simple enough for you to actually understand? Buffett famously avoids things he can't easily explain. And only after a company passes those 3 tests does he move to the final one: is it selling for less than it's really worth? That's when those metrics like the P/E ratio come back into play.
Okay, so you've done your homework. You've used Pillar 1, and you've found a fantastic company at what looks like a fair price. But that brings us to the next massive question. When is the right moment to actually click that buy button? And that brings us to our second pillar, timing.
Now we're entering the world of technical analysis. So if fundamental analysis is all about the company's health, think of technical analysis as reading the market's mood. It's not concerned with earnings reports, it's all about the forces of supply and demand that you can see right on a price chart. It's based on this idea that price movements aren't totally random. They tend to follow patterns and trends that are driven by human psychology. Those big waves of optimism and pessimism.
One of the most important concepts here is the trend. Let's just visualize an uptrend for a second. Imagine you're walking up a staircase. The price goes up and hits a new high. That's one step. Then it pulls back a little, but that low point is still higher than the last low point. Then it pushes up to an even higher high. This pattern, higher highs and higher lows, is the classic signature of an uptrend. It suggests that buyers are feeling confident and they're in control.
And of course, the opposite is true. A downtrend is just like walking down that same staircase. You get a series of lower lows and lower highs, and that's a signal that the sellers are in charge. The core idea of technical analysis is pretty simple. You want to trade with the trend, not try to fight it. As the old saying goes, the trend is your friend. Because hey, even a great company can see its stock price fall if the overall market mood is sour, so timing your entry can make a huge difference.
All right, let's talk about the fun part: how you actually get paid. Pillar 3 focuses on a really crucial distinction that can totally change how you approach investing. It's all about the difference between just building wealth on paper and actually creating an income stream.
Most people, when they think of investing, they're thinking about buying low and selling high. That's a capital gain. You buy a stock at $50, you sell it at $70, and boom, you've made a profit.
And that's fantastic for building your net worth, but you only see that cash when you sell. But there's this other way, generating cash flow. The classic example is owning a rental property. Every single month, your tenant pays you rent. That's cash in your pocket, right? It's consistent income, even if the value of the house is going up and down. You're literally getting paid just to own the asset.
So how can we do that with stocks? Well, the simplest way is through dividends. A lot of stable, established companies will share a portion of their profits directly with you, the shareholder. It's like getting that little rent check in the mail. A more advanced tool for generating cash flow is using something called options. Now, an option isn't the stock itself. It's a contract that gives you the choice, the right, but not the obligation, to buy or sell a stock at a price that you lock in today. It's that flexibility that makes it such a powerful tool.
Now, options can get complex, but let's just look at the two basic types. A call option gives you the right to buy a stock at a preset price. You'd be interested in this if you're bullish and you think the stock's price is going to go up. It's kind of like having a coupon to buy something at yesterday's price. A put option is the exact opposite. It gives you the right to sell a stock at a preset price. You'd buy a put if you're bearish and you believe the stock is going to fall because it lets you lock in a higher sale price.
So far, so good, right? We found a strong company, we've used the charts to find a good entry point, but what happens if we're wrong? I mean, it happens. Our fourth and final pillar is arguably the most important one of all. It's all about protecting your money and making sure you can stay in the game for the long haul.
Look, investing without a risk management plan is like a pilot deciding to take off without doing a pre-flight check. It's just not something professionals do, ever. Before you put a single dollar on the line, you need to know your complete flight plan, where you're getting on, where you hope to land, and exactly where your emergency exit is.
A professional approach means you define 3 key prices before you even think about buying. First, your entry point. Second is your target. That's the price where you say, great, I'm happy, and you sell to take your profits. And third, the most crucial one is your exit, what's often called a stop loss. This is the predetermined price where you admit the idea isn't working out and you sell to cut your losses. It's like a circuit breaker that pulls emotion out of the equation and protects you from a really big loss.
At the end of the day, every single investment decision you make comes down to balancing these 3 factors. The risk is what you stand to lose if your stop loss gets hit. The reward is what you stand to gain if you hit your price target. The real art of investing is finding situations where your potential reward is much, much greater than your risk. For example, a common rule of thumb is to only take trades where you have at least a 2-to-1 reward-to-risk ratio. That means you stand to make at least double what you're risking if you're right.
So, let's put this all together. We've looked at these 4 pillars one by one, but their real power, their magic really, comes when you use them together as a single cohesive system. Imagine this in action. Using Pillar 1, your fundamental research uncovers a solid company with low debt and great leadership. So you add it to your watch list. Then, for weeks, you watch its chart. Using Pillar 2, you notice it's been in a downtrend, but now it's starting to show signs of a reversal. It's making higher lows. You decide this is a potential entry point. Then, using Pillar 4, you set your price target for a 20% gain, and you set your stop loss for a 10% loss. That gives you that 2-to-1 risk-reward ratio. And finally, with Pillar 3, you remember this company pays a steady dividend. So, even while you wait for the stock to go up, you're earning a little bit of cash flow. See? That's how they all work together.
And that brings us to a really important final point. Our goal today was to build your awareness, to give you the map. But having a map is not the same as having experience walking the trail. True proficiency, real skill, comes from practice and from a commitment to keep learning. You now have a framework, a process to replace that old gut feeling. The journey is yours to begin.